Your taxes will become more complicated as you earn more money. So, if you earn more than the average individual, you must contact with a qualified accountant to determine how to lower the amount of income taxes you pay. In addition to taking your standard deduction and other deductions, there are several things you may do to lower the amount you pay. Hey, everyone. Welcome to Entrepreneurship Academy. In today's video, we are going to talk about the 8 strategies that help millionaires avoid paying taxes. So without further ado, let's get into it. Strategy number 1. Charitable donations. Donating to charity is one way wealthy people can reduce their tax liability. However, there are some ground rules to follow. In general, charitable contributions are deductible only if you itemize. Itemizing means claiming deductions for specific expenses rather than the standard deduction. For 2022, the standard deductions are as follows: $25,900 for married couples filing jointly, $12,950 for single taxpayers, and $19,400 for heads of household. Unless your charitable contributions and other deductions exceed that amount, it is better to take the standard deduction. If you itemize and want to claim the charitable deduction, you can generally deduct no more than 60% of your adjusted gross income. There are, however, some exceptions for qualified contributions. Cash contributions to public charities or certain private foundations are examples of this. However, for tax year 2022, taxpayers can deduct up to $300 in donations for single filers, or $600 for married joint filers, even if they do not itemize. The Coronavirus Aid, Relief, and Economic Security (CARES) Act resulted in the creation of this special benefit. These deductions are only available for cash donations to charities. Strategy number 2. Set up a donor-advised fund. You are already aware that making a charitable contribution provides the opportunity to claim a tax deduction in the year in which the donation is made. What you may not be aware of is that if you establish a donor-advised fund, you may be able to claim a tax deduction for contributions made over a number of years. A donor-advised fund is a charitable fund that you can establish that gives you the ability to direct how and when funds are distributed to specific charitable organizations. Contributions can be made this year, and you can claim the full amount of tax deductions on your tax return this year, lowering your overall tax bill. Then you can decide how much money you want to donate each year and where you want to donate it in the future. Basically, when you contribute to a donor-advised fund, you are eligible for a tax deduction. Strategy number 3. Buy municipal bonds. By purchasing a municipal bond, you are lending money to the issuer in exchange for fixed interest payments that will be made throughout the bond's duration. At the end of the period, the bond is considered to be mature, and the original investment is returned to the original purchaser. Generally, the income from tax-exempt bonds is exempt from all income taxes, which includes all federal, state, and local taxes, as well as from capital gains taxes. Even the interest payments made on the income may be exempt from taxation in certain circumstances. However, despite the fact that municipal bonds typically generate less income than other taxable bonds, they may be an effective strategy for lowering your overall tax burden. Calculating the tax equivalent yield of a bond can help you decide whether or not they are worthwhile. Strategy number 4. Use a health savings account. You can also contribute some of your income to a health savings account, HSA, to save on taxes. You may only contribute if you have chosen a high deductible insurance plan. The maximum contributions for 2021 are $3,600 for individuals and $7,200 for families. If you are 55 or older, you can contribute an additional $1,000. HSA contribution limits are linked to inflation, despite the fact that medical expense increases typically outpace inflation every year. Your HSA funds can be used for medical and dental expenses, as well as related costs such as over-the-counter medications and first aid supplies. If you withdraw money and use it for non-qualified expenses, you'll have to pay taxes on it. You should be aware that the money in your HSA is yours forever, as opposed to the money in a flexible spending account, which must be spent during the tax year. As a result, you may want to consider an HSA. You must weigh the risks of a higher deductible against the potential savings. Strategy number 5. Invest in companies that pay dividends. Your employment income is taxed at ordinary income rates, which means you pay a high tax rate if you make a lot of money. You may be aware that capital gains are taxed at a lower rate, implying that earning capital gains has tax advantages. Investing in companies that pay qualified dividends is one way to accomplish this. It is crucial to understand that ordinary dividends are taxed in the same way as ordinary income. To take advantage of the tax benefits of dividend income, you must invest in companies that pay qualified dividends, which must be issued by a U.S. company or a qualifying foreign company. On page 20 of IRS Publication 550, you can find information about which companies are not considered qualified. If you have previously invested in dividend-paying companies, the dividends will be reported to you on Form 1099 DIV. For qualified dividends, the maximum federal tax rate is 20%. Strategy number 6. Family Limited Partnership. Millionaires may also choose to form family limited partnerships in order to avoid paying large estate taxes. The formation of a partnership and the transfer of ownership of assets to the partnership are completed. The partnership's ownership interest is transferred to the heirs, and the value of that ownership interest is discounted in accordance with estate tax regulations. This reduces the amount of assets that pass through probate and are considered to be part of the taxable estate after the death of a loved one. However, once again, there are costs associated with forming a family limited partnership in order to avoid taxation. It is not usually necessary to do this unless you have a substantial estate that would be subject to taxation in the future. Strategy number 7. Property taxes. Property taxes are deductible, but you must itemize your deductions in order to take advantage of this benefit. You can deduct up to a total of $10,000 from your federal income taxes, for married joint filers, or $5,000 from your federal income taxes, for single tax filers. This $10,000 limit applies to state and local taxes, including property taxes as well as state income or sales taxes, and it does not apply to federal taxes. Nonetheless, it may be a viable option for lowering your tax burden. If your property taxes and other deductions do not exceed the amount of the standard deduction, itemize your deductions is probably not a good idea. Strategy number 8. Roth IRA conversions. Roth IRAs are tax-free retirement accounts that can help you save money even if you are in the highest tax bracket. Unlike traditional IRAs, Roth IRA contributions come after tax. The tax is paid before the contribution but not when the withdrawal. That's not obvious, but it is. Profits from your Roth IRA are also tax-free. You can also convert a traditional IRA or 401k into a Roth IRA. When you have less income than the previous year, or when you are retired and temporarily in a lower tax bracket, you should convert your Roth IRA. This strategy works if you can postpone mandatory withdrawals until age 72. Because it's easy to overlook, especially when people are focused on tax deductions to lower their taxable income. So, that's pretty much it for this video. Hope you liked this video? If so, then, don't forget to subscribe to the channel and click the bell icon so you never miss any video. See you in the next video. Till then, take care. Thanks for watching.